Just this morning, GDP reported a negative 0.9 decrease. The Feds raised rates 75 basis points. What does this all mean? All this and more on today's episode. Welcome back, everybody. This is New Front Radio. I'm your host, Internet Joey, alongside Jaime, where we cover topics and ideas designed to provide you with some alpha. Today's date is July 28th, and let's dive right on into it. And just a disclaimer, obviously none of this is financial advice. This is for entertainment purposes only. So let's go ahead and dive on into it. Jaime, 75 basis points for the Feds to say they're pretty, they're on par to combat inflation. That's their number one goal. What is 75 basis points telling us?
So this is the second time in a row they do 75. Obviously, since the beginning of this year, they've been aggressively raising. They've become very hawkish, which just means they've been raising interest rates. They're trying to combat inflation because that's the biggest issue we have right now. Despite the fact that it was 75% basis hikes, we still saw a rally in the markets. And if you listen to the speech that Jerome Powell had, it wasn't super hawkish. It was almost like he was saying, this is where we're at. This is where we want to be. We're going to be monitoring the next couple of months and just do a little bit of tweaking here and there. They're probably still going to raise because they're still combating inflation. But it seems like we're out of the woods in terms of the most aggressive rate hikes. At least that's what it made it seem, and the markets definitely thought so. Since yesterday, we've had a pretty good rise in equities and in crypto. I believe Bitcoin right now is up 3.5–4% just on the day. If you add that to yesterday, it's almost 5–6% up. So we're doing pretty good right now, and it seems like the Fed might be softening a bit for the rest of the year.
Yeah, that's absolutely right. I mean, we're definitely seeing a relief rally. We have the S&P up 1.2%. We have NASDAQ up 0.8%. Bitcoin up almost 4%, 3.67%. The Dow Jones up 1% and the Russell 2000 up 1%. So definitely markets are seeming to, be okay with the 75 basis points. I think they probably priced it in maybe a while back. And once it was confirmed, basically, the relief rally started. And I like to go back to one of the points you brought up. It definitely feels like the Fed is definitely walking this thin line between being, saying they're hawkish and then, really what they're actually doing behind the scenes. Because obviously, remember, they don't want to increase rates too quick and then we spiral into we're already in a recession, but even a worsening recession. So, we definitely have to see we want to know what they do and then, and then hear what they say. But remember, it's always like paying attention to what their actions are more than what they're saying. So they're saying they're leaning more neutral. I kind of believe that, but we'll just have to see. And then overall today with the GDP shrinking almost a whole percent, 0.9%. It seems like the markets kind of already were predicting negative growth for the second quarter. So they still rallied today. So it's pretty interesting.
And it's super funny, and we're in a super weird spot because we have confirmed inflation, we have confirmed recession, we have 0.75 basis hikes back to back, and still the markets are like, all right, cool, like let's go up.
Right,
and
right.
It's almost
we're in the time where a 75 basis points increase is bullish, right? So I mean that says something, doesn't it?
That doesn't make sense. That's so crazy. And it's just that it's for the last 2 years we've been playing this game with the Fed where we're trying to guess what they're going to do next. And I think the markets have gotten so good at calling the Fed's bluff that we already know all their hands are already on the table. We know what they're going to do next. We know what they have to do next. Frankly, they don't have that many tools left in their pocketbook and their playbook. It's raise interest rates and just let the economy go through a mini recession and drown out all the bad equities, all the bad assets.
Yeah, definitely. I think it's a flush of not only the leverage, but of, bad assets, like you said. And ultimately, it should be good for the health of the economy and for, honestly, just the average consumer. So we'll have to see. Once again, these are unprecedented times, and it's all very interesting to see all this unravel in real time. Let's go over some quick charts, just a quick market briefing today, kind of what the markets are doing. Let me go ahead and share my screen here. This always takes a little bit. So let's start off with the VIX today. Let's check out that volatility. So right here we have this, I kind of have like this multi-month resistance line traveling down, and then kind of where it's at today, and then kind of we see it entering this kind of this ascending triangle.
Mm-hmm. Explain for those who don't know what the VIX is. What's the VIX?
So the VIX measures the volatility of the S&P or basically the market. So it's how volatile the markets are. So increasing VIX means more volatility, decreasing means more predictability, and ultimately rising markets. So we can see that the VIX has actually come down ever since, let's see here, June 13th. It's been kind of pulling back, and now it's right up against this resistance line, which ironically enough is also on the 200-week moving average. So I would say I would be careful around these areas. This is where if the VIX is going to bounce, we can see a bounce here in volatility, and then that can possibly bring markets down, which would kind of make sense after we see such a relief rally. Well, the water is still choppy, so we could definitely be in for some more turbulence heading into the weeks to come. So that's definitely something to look into and just to consider. The next chart, I'm just going to go over the quick. Let me just share my screen here. I'm just going to go over the S&P. So for the S&P, you can see that we've actually broken above this descending wedge. So if we we basically broke above it, retested it, and now we're bouncing up, and now we're testing this resistance line at basically 4,069, almost 4,070. So if we can close above that, that'd be pretty good. And ultimately a breakout above this wedge would be ultimately bullish. That's just something to look at. Obviously, this is we don't really know where the markets are going to go right now, but as far as the price action of the S&P, it is breaking above the wedge it was forming. Also, just note this yellow vertical line here I have indicating where the 10 to 2 year bonds inverted, and you can see ever since we inverted, basically we've been going directly down. So that's pretty interesting as well.
Gotcha. Okay.
Moving on, I have here. This is once again the 10 to 2, like I was just talking about. You can see how we're still pretty inverted at the moment, which is not a good sign. Once we can get out of this, basically this negative inversion and start trending back up, we'd be you can almost say we'll be out of the woods at that point. So once again, the 10 to 2 inverse is not looking too good, but let's see how that unfolds. In lighter news, we actually have the NDTH, which is the market breadth, and you can see here how it's actually bouncing above this support, basically the support line, and it's a multi-year support line. That's indicating that a lot of these companies that are in the NASDAQ are actually bouncing above or reclaiming their 200-week moving average. So this is actually a bullish development. So that's something to look up, to consider as well. Might be indicating we might be in actually a strong reversal. Let's take a look at crypto really quick. Here I have the total. You can see I've had this wedge here, and we were bouncing. We were kind of consolidating for a while. We finally broke above it around July 18th. We played above it. We retested it basically on July 25th, wicked down below, and finally broke above that support line today, or that resistance. So that's a classic basically break to retest to continuation. So this is actually a bullish development as well. We could definitely see price basically the total market cap of crypto go back to maybe this support line of $1.1 trillion. So that'd be pretty good. That's probably our next target.
Yeah, that's pretty awesome to see. I know a lot of the crypto people in the crypto community were suffering and were kind of down because we were under $1 trillion, and that just it's a really big psychological number, and it's nice to see we're finally above that $1 trillion, and hopefully we see some more bullish momentum in the entire market now.
Absolutely, and this is definitely we don't want to get too optimistic too quickly, but as of right now, these are definitely more positive indications of possibly a reversal, or at least, the very least, a relief rally to recapture some levels. So not all is bad in the market as of right now. And yeah, that's it for basically today's quick TA. Just update of kind of what the price action is looking like.
Awesome, man. So let's go ahead and move into some articles. I know we had looked into some articles beforehand. There's this one article titled "The Everything Bubble in Reverse." If you want, you can get started on that. I know you were really interested on that article too.
Awesome, let's do it. I'll go ahead and bring that article up right now.
So it was really interesting because it was comparing what's been happening now with 2022 and 08. I know a lot of people are kind of panicking with the whole R word being thrown around, the recession, and comparing it to 08. And there's a little bit of a silver lining to what's happening now compared to 08. And it's basically that banks are actually in a way stronger position than they were in 08. If you want, you can go over some of it right now with the article you pulled up.
Absolutely. So this is an article from George Salapa, and basically Medium writer, and he's writing about the everything bubble in reverse. And basically what he means is that how the bubble may not pop, right? It doesn't necessarily have to pop. So long story short, he makes a good point here. He says, in 2020, the Fed didn't just buy the markets, they went further. So in normal quantitative easing, like in 2008, the Fed would buy treasuries and other securities like mortgage-backed securities from the banks, right? And basically this made the banks in 2008 very leveraged. And that money didn't actually go back into the economy. It actually stayed within the banking system. And what was happening was banks were basically trading amongst each other's these different products, CDOs, right? CDO is
collateralized debt obligation.
Right, a collateralized debt obligation, which is basically a basket of different assets and loans and so forth. So they were trading amongst each other, right? And this was continuing to actually escalate the issue and the bubble of 2008. And that actually made kind of that quantitative easing deflationary because the money never actually really entered the market, right? It stayed within the banking system. So here we see, in fact, the QE post 2008 was mostly deflationary. The money stayed in the banking system, but the asset purchases also made the rich richer and making a huge mental shortcut here. Eventually found its way to venture capital funds, astronomical startup valuations, and the stock market. So it continued to bubble the bubble, right? But what happened, what was happening in 2020 was that the money was actually going into the hands of the consumers of the regular people. And this helicopter money was actually more inflationary than it was in 2008, because once again, the money was actually entering the hands of the people and being spent on assets like going back into the market or being spent on, consumer goods and stuff like this. Once again, growing the GDP.
Yeah, and this is actually something that I struggled with early on. I know a lot of people still believe this, that the bailouts, the bank bailouts that happened in 08 was just a ton of money printing, and that was going to cause inflation, and that's why money went up. But actually, if you really look at how QE worked back then, that money never touched the public. That money went directly to picking up all the bad things that banks had on their balance sheets, all the CDOs, all the really triple C rated mortgage-backed securities.
Triple C
Yeah, like
rated.
just the garbage, right? And the Fed said, hey, I'm going to buy it off of you, and I'm just wipe it clean off my books. Since I can print money, I will, right? And obviously a lot of people were angry at this, but the truth is that money never became inflationary because it was just wiped clean, and the masses never got to touch that money. So the money was really never in circulation, opposed to what happened in 2020. That money was literally just helicopter money. It was just given away to everybody, whether that was through unemployment, that was through SBA loans, that was just through COVID relief money. Everybody had some cash on hand. And the truth is the majority of the people who live in the United States and in other countries use it on depreciating assets, and they use it on perishable goods. So that's when we had an inflation problem. Because now all that money just disappeared into really bad assets that wasn't producing anything.
I agree, right. And that's a great way to put it. So basically, it's not about the helicopter money, but it's actually about how the helicopter money is injected into the economy. So, if you compare it from 2008 to 2020, they were injected in two different ways. So, yeah, once again, you bring up a great point. So, anything else to add to that, Jaime?
So, yeah, I wanted to add, so let's separate 08 from 2020. So we've identified that we're in two different positions. 08 wasn't inflationary. We are in inflation right now. What happens next is a question that a lot of people are going to have. And really, it's in the hands of the Fed and banks. If the banks and the Fed say, hey, we need to keep printing to keep the merry-go-round going, then we're just going to keep having inflation and asset prices are going to keep escalating. Because as far as I know right now, the banks' bank sheets are pretty good. They don't have any garbage on their bank sheets, and their credit is high. I mean, they're lending a lot. They're still lending. So there's really not a banking crisis. It's more of an inflation crisis. So if the Fed and banks just stop printing right now and raise interest rates, kind of like they're doing, and they just stop, then we'll probably go into recession, pretty severe recession for the next year and a half. But eventually it will subside and it won't be as bad as people are anticipating. Of course, there are major things wrong with the economy, and there's other world events that how you have to factor in. There's a lot of variables. But if we're just talking about the recession and inflation, it can be solved by just stop printing money, stop QE, and wait. And after a year and a half, 2 years, it should be solved, and the economy should go back into growth phase.
Yeah, definitely. That's a great point. And I want to also bring up here, so what I like here about what the article also mentions is that right now, according to Bank of America, fund managers are actually hoarding cash at records never seen before since 9/11. So fund managers are sitting on a lot of cash ready to be deployed back into the markets, basically at a flip of a switch. So, as soon as the Fed decides to become dovish, right, to start maybe quantitative easing once again, bring down those rates, money is going to flood the markets. And you don't personally, I don't want to, try to time when this is going to happen, try to time the bottom. But ultimately, once again, that DCA strategy, just averaging into the market, building a nice position over time, you will eventually catch that swing to the upside. And the likelihood of you trying to time that swing to the upside, is practically zero. So you kind of just want to have time in the market and not time the market.
100%.
I guess we'll just end this with this article right here. So to conclude, he says, things are bad, but that doesn't mean the everything bubble has to burst. The narrative in the economy, even a slight chance of tone, can turn the investor sentiment and the money starts pouring in. So like I said, a flip of a switch can really just turn this entire game around. So
Yeah.
What I think where the keystone to all of this, he says it right here. He says prioritizing real things like commodities, energy, defensive stocks over growth. That's what we want to see this economy do. That's what we want to see the market do. And that's ultimately going to strengthen the infrastructure of the economy, because it's not going to be propped up via leverage, via speculation, and all these companies that are basically vaporware. So once again, he says here, the global macro might have a good chance. Oh, I'm sorry. The global macro might change for good, prioritizing real things, commodities, energy, defensive stocks over growth. And that's what we would possibly want to see if we're going to get out of, this cycle of over leveraging and over speculation. And I think he ends it really well with that statement.
Yeah, absolutely, man. And a lot of people have been avoiding the R word, recession, but the truth is we're in a technical recession already. As soon as July 1st hit, we were in a technical recession. Now that we got the GPI numbers, we know we're in a recession, despite the White House, Janet Yellen, and Powell all trying to avoid the actual word. I mean, Janet Yellen yesterday or a couple days ago was asked about recession in a press conference, and she's like, "Oh, we're not in a recession. We're in transition in which growth is slowing," which is just it's a joke. It's a joke. I mean, I can't believe she said that. And again, there was a press conference for Joe Biden's press secretary. He said something similar, trying to avoid the question or change the definition of recession. The truth is, we are in a recession. Now, the next step is how long are we going to be in a recession, and how bad is it going to be? That really falls into the hands of banks and the Fed, and whether they want to give us a basically like a quick save with more printing, or just let us go through it for the next 2 years.
Absolutely, absolutely. And no one's to say which one of those is the actual correct answer. So you really hit it on the nail with that. Obviously, the market's hands are tied. The Fed is doing, quote unquote, the best they can. So we really just have to see how they decide to continue to play this entire matter. So yeah, great way to summarize the everything bubble. Here I have a second article I like to go over, and it's kind of tailored back to this entire mess. It's called "Economics is 100% BS." And getting into this article, the author basically is describing how the statistics that the Fed uses, the government may use, they need to be taken with a grain of salt, because these data points are really manipulated. So once again, Economics is 100% BS by Trevor Stark. And by the way, we do plan to have Trevor Stark down for one of the episodes upcoming. So, stick around for that. But basically, he points out some good points here. He says, the problem is these stats are complete BS. Right? He's being a little bit inflammatory, but what he means is that GDP doesn't measure the economy, unemployment doesn't measure how many people don't have jobs, and CPI doesn't measure inflation. So to kind of elaborate, see, GDP measures how many dollars are being spent, but the problem is that how many dollars are being spent doesn't equal the health of the economy, and that's kind of the disconnect between the two. Right? GDP is a very overgeneralized statistic that, we're spending more. Well, the economy must be doing better. And that's just not true. So he said
it sounds almost like it's a manipulated number that's given way too much weight. Like
absolutely,
people shouldn't give it as much weight as people do.
Exactly. And that's exactly what goes on. So it says the problem with this is that this is easily manipulated by the government in order to make the economy appear as if it's doing well. So basically, the government can print as many dollars as they want and artificially pump up GDP, right? The government has this incentive to keep up the GDP and the ability to control it. So because the government spending is a part of the GDP, the government can print money, spend it on anything, and GDP will therefore increase. And that's exactly why GDP is kind of a funny statistic to use when calculating the strength of an actual economy. And I think he just brings up, it's a great point to make when it comes to these statistics that we always hear all over the news. We see on social media, wherever we're hearing these things from, right? They must be taken with a grain of salt.
Yeah, absolutely, and it's highly politicized. So
That too.
every politician and every Fed position or every economic position that works in government has an agenda, and they'll skew the numbers in a certain way to fit their agenda. So they're not the most reliable sources. And I know that's you feel strongly that that's one of the greatest things that blockchain can solve is give us real numbers, real data in real time. And that's just this is old technology. Collecting data this way. I mean, a lot of data is collected by surveys, doesn't even make sense anymore, and it's very outdated.
Right. I think what blockchain technology can do, for example, is definitely make it more efficient and more accurate when it comes to, gathering these data points. And, that way it can be a net positive for humanity if we can really get these numbers right, because then we would actually have a clear forecast on what needs to be done in order to increase productivity, to really help the consumer, and so on and so forth. So to add to that, he writes, who cares, right? The economy is more than just dollars spent. We should be focused on the purchasing power of citizens or their quality of life. Because GDP only measures how much money is being spent in the economy, the government can print money and artificially pump GDP. And then with that being said, even if everyone in the US is poorer than they were last year, economists can say GDP is up, everything is going great. And here you could see what the problem with these statistics, how there's a problem with these statistics. So just to conclude with that, once again, so to be considered unemployed, basically you have 4 weeks that you haven't applied for a job. So after those 4 weeks are up, you're actually not considered unemployed. You're not even considered in the labor force. So right here, he writes, if you have not interviewed for a job in 4 weeks, you are officially no longer unemployed. It makes no sense. You're just not even included in the labor force. Bada bing, bada boom. What does this mean? And it's just crazy
that's ridiculous.
Yeah, it's crazy the way they define these things. So,
and I feel like sometimes you'll get these numbers and they'll make a small tweak to the definition of what they think it should mean, kind of like unemployment, and all of a sudden the number changes from 1 month to another completely drastically, and they'll claim a win on a press conference. Hey, we unemployment dropped 3%. I mean, look at how amazing our labor force is doing. And
exactly.
It's just that half of them are just not applying for jobs anymore because there are no jobs.
It's 50% semantics, 50% politics. So, who does that really benefit? I mean, not saying the politicians, but it could be the politicians, right? So finally, he just ends it here with, so the first step is accurate economic data. With proper information, people can understand what the problem is. Instead of blaming immigrants or billionaires, people would shift to blaming the politicians who have been lying for so long. So obviously, whether you're Republican, Democrat, doesn't matter. I'm sure every human has underlying motives. So, that's a factor of life, can't be ignored. And with more accurate data, it puts the power into the people's hands once again. And now we're not relying on politicians to get the work that needs to be done. And I guess we can end that article now. Anything else you would like to add?
I mean, I would just say, to summarize the article, to not take some of these numbers that come out of economic statistics to the heart. I mean, take it with a grain of salt, because a lot of these numbers are artificial, or they're construed in a way to make you think a certain thing, and you shouldn't make life decisions off those percentages just because they're so broad, and they're not giving you the real deal of what's going on in the real economy or in the real American life.
100%. Okay, so what we have finally the last article we're just going to cover really quick is titled let me pull it up here actually first. And all of these articles are found on medium.com, perfect place.
Medium.
Anyone can blog on there. It's just a great way to basically outsource different people's opinions and, read really what everyone's thinking. So I use it all the time, and obviously that's what we're kind of reviewing today. So this article is written by this individual. How do you pronounce that, Jaime? Sylvain?
Sylvain.
Sure. So
I'd say Sylvain.
I follow this guy. I've been following him for a while. He writes a whole bunch. I actually really like his articles, but he makes a point that education is the way out of vicious cycles of Bitcoin's relentless repetition of bear markets. So what he's basically saying is that if we kind of want to minimize the volatility of Bitcoin and just crypto in general, it's really to get people educated. And it makes sense because what's going to drive a lot of market volatility, buying and selling, is going to be speculation. So, a lot of people get into let's say crypto because it's like a get rich quick, you can make a lot of money. That in itself is what inherently brings the volatility to the markets, because now you have asset evaluations built on pure speculation, right? So he says here, a painful market brings two positive things: a chance to study Bitcoin, and here he says the Bitcoin revolution, and then a chance to accumulate BTC at a discount, right? So he says Bitcoiners create bull markets. And it makes sense because during regular time or during a period of accumulation, people are studying Bitcoin. They're understanding the father of all of crypto, which is Bitcoin, right? So Bitcoin will begin to appreciate. Once Bitcoin begins to appreciate, it's all eyes on the crypto market. And now everyone is trying to get in, which means how are they going to get in? Probably not via buying Bitcoin, but buying other assets that they're speculating on. And that's basically what he writes is the perverse effect of creating basically shitcoiners, right? So not to get too much into it, but here he has this nice chart. So he says bear markets create Bitcoiners, Bitcoiners create bull markets create shitcoiners, and then shitcoiners create bear markets. And right here, he notes that education is the way out of the cycle. And I absolutely agree, because Bitcoin really is the most, what's the word I want to use? Basically, out of all the Bitcoin is not a crypto. Bitcoin is Bitcoin, and crypto is everything else. So how decentralized Bitcoin is, the mathematics behind it, the network, there's really only one Bitcoin. And that's why.
Well, also Bitcoin has first mover advantage, and Bitcoin has the longest track record. So from a safety standpoint, it's also the most secure asset to invest in. If you're just looking into the world of crypto, it's the least risk asset you can buy.
Absolutely. I mean, just look how large the network is. I mean, Bitcoin itself basically makes half of totals of evaluation. So it's if total is 1 trillion, Bitcoin is making up half of that, which is 500 billion. So it's definitely big participant. So I want to share this meme right here, because I think it's a perfect meme to kind of follow what this guy is writing on here. Let me pull it up here. And everyone's seen this meme before. It's the rise and fall of Rome. So bear markets create Bitcoiners, Bitcoiners create bull markets, right? So it's so funny. And then bull markets create shitcoiners, and then shitcoiners create bear markets. And it's so true, because what you have happen is as we saw in basically from 2020 to 2022 almost, is that Bitcoin started moving first. Everyone started buying Ethereum, started getting into Ethereum Classic, Bitcoin Cash, right? All these other ones. And then by the time Bitcoin is already 4x, everyone feels like they missed the boat. Well, what happens next? Now you have Dogecoin, you have Shibas, you have all these other coins now going parabolic in evaluation because they're being pumped by uneducated speculators, right? And that's kind of ties back into what he writes when he says, really, it starts with education and educating people on why Bitcoin really is the one of the best assets among all of these other coins.
Yeah, I couldn't agree more. And in terms of education, it's not just educating the investor themselves, but something that's been happening over the last 2 years and even till today is education is starting to reach Congress and it's starting to reach people in power. And where I think we're really going to start breaking that cycle is once those Congress people and those lawmakers start implementing regulations, and we can get rid of some of those garbage coins that are not serving any purpose, don't have any utility, and now the entire ecosystem can, okay, those coins are not good because they're not regulated, or they're not safe, they're deemed not safe cryptos to buy or
Rug
assets to
pulls.
buy, and these are the rug pulls. And now you can classify, okay, these are the regulated cryptos that we can buy because they're approved, they have a stamp of approval from Congress or from whatever law that is there, and now investors can make a more intelligent decision moving forward, and we can kind of start breaking down that cycle. And we've seen this in markets. If you look macro enough, eventually new assets, they go through this phase of just up and downs, but as it matures, as more people learn and they come in and they get educated, the asset starts to be less volatile and
Stabilize,
go up
right.
slowly. Exactly. So it's all just it's kind of part of the growing pains of being a new asset on the
Mm-hmm.
block, competing with Wall Street.
Yeah, and it's funny you say Congress and the legislators because they themselves are trying to understand this technology. So it's
Yeah.
is Bitcoin a security, right? Is it a commodity? Is it a currency? They're trying to still figure this out. And if you ask me, before they actually, because obviously when crypto was coming out hot, they were just trying to implement old legislation, old law into such a new asset technology, whatever you want to call it, that a lot of those laws and regulations kind of break down when it comes to such a new technology or asset class. For example, they were trying to say that DEXs, right, decentralized exchanges, were brokers. But it's kind of odd to classify a decentralized exchange as a broker because, number one, the DEX is really just an application, and the developers, the owners of it, really don't know who the users are. They can obviously monitor how many users there are, the volume and stuff like that, but there is no KYC, which is know your customer. So there's no way for them to actually pull records on who are the people doing these transactions. So if you want to say a DEX is a broker and then start asking for all this information, well, the DEX isn't going to have it, because that's just not the nature of this type of technology or that product. So, even the government and legislation, they're going to have to understand this technology if they want to properly, if they want to properly regulate it moving forward.
Yeah, absolutely. And I acknowledge that it's a really big job to tackle, because it's not just, oh, we're going to regulate crypto. There's so many facets in crypto. There's DeFi, there's commodities, there's derivatives. It's a really hard job to do. And as we know, there's a crypto bill that was presented a few weeks ago. I think they decided that they're going to go ahead and break it up into chunks because it was way too much for anybody to agree on. So now they're going to break it up into break it up into chunks. And I think the first thing that they're going to attack is stablecoins. I mean, we've seen that they've aggressively attacked stablecoins because that's just not something that they want to compete against sovereign currencies, whether that's the U.S. dollar or the yen or the euro. They're not going to have it. Especially, we know lots of these politicians have an agenda to create CBDCs that they can manipulate and control. So it seems like that's the first regulation we're going to get, something in terms of stablecoins, and then later on we're going to get into securities. I know a lot of people are following the Ripple case. I definitely am, and we'll see what comes out of that. We might have some answers within the next 6 months or less.
Absolutely, that's a great point because if if anything is gonna, maybe replace fiat like the US dollar, it's gonna be just the digital version of that, which is a CBDC, not necessarily Bitcoin, where it's not Bitcoin is not very scalable. I don't know if Maxis will take offense to that, but in just in the sense of how it's designed, right? It's not really designed to, accommodate the entire world with those type of transactions. So, and on top of that, Bitcoin can't be manipulated the way they would like the CBDC to be manipulated. So, that definitely makes sense for them to kind of target the closest thing they're familiar with, which would be these stable coins. Great point.
Correct. Yep. Absolutely, man. Awesome, man. So we've had a pretty awesome podcast. I think we should end it here. Before we end it, let's go ahead and look back at last Thursday. We made a prediction on Bitcoin on whether we were going to be bullish or bearish, and our prediction came true. Bitcoin's currently at 45. Oh, I'm sorry, 23. I wish it was 45. 23,000. 23,800 back in Thursday when we did the prediction. It was at 22. So I'm going to ask you again, and then I'll give my perspective from today to next Thursday. Today's the 28th to next Thursday. Are we bullish or bearish?
Sheesh. Let's see. Do we have any news coming out next week?
I don't think so. I think we went through all the worst things. CPI. We did the interest rates. So we're through the worst of it now. So the Fed's not going to bother us till late September. So we don't worry about that. In terms of crypto, I think it's open season.
So I'll say this: if we get a bounce off that VIX, off the volatility index, like I was mentioning earlier, we'll see probably some. Who knows? We can probably pump more, and then we can see some pullback and just overall volatility, depending on the VIX. But I will say, I do believe the VIX is going to be bouncing soon. But we'll just have to see. I do think we can see the dollar retracing a little bit. And if that would be a good sign for equity markets.
Yeah, I would agree with you. I think from now to next Thursday, we're probably going to be a little bit higher, and we're going to see a little bit of more rally in the market. So I'm short-term bullish.
Okay, agree. Alrighty, guys, that wraps it up for today's episode. Leave your comments below if you have any topics you'd like to see us discuss. We're all open ears. We want to kind of, see what the audience is more interested in. If there's any specific charts you would like us to review, that'd be nice too, or any specific asset class or anything like that. Anything else, Jaime?
That's pretty much it, man. Guys, don't forget to like, comment, and subscribe. And like Joey said, if you have any suggestions for us, drop it in the comments below. Follow us on Instagram and just hit us up, DM us, and ask us whatever you would like us to talk about in the next podcast.
All righty, guys. That wraps it up for today. Take care. See you on the next episode.
All right. Bye-bye.